Good day, this is Shauna Casey, and welcome to this SOS educational webcast, Defeat Disturbing and Dastardly Disclosures. Due to the large number of attendees, no conference call service is available for this webcast. The sound will broadcast through your computer speakers. However, if you wish to ask a question at any time during the presentation, please feel free to type it into the questions and answers panel of your go-to webcast console, and we will do our best to answer them as they come in. Any questions that we don't get a chance to address during the webcast, we will follow up afterwards in an email. This morning we sent an email with a link to the presentation materials to everyone that registered as of 10 a.m. Pacific this morning. This session will also be recorded, and we will send a link to the recording and materials in the next day or two. I hope that all of you are familiar with Stock and Option Solutions, or SOS as we are more commonly known. For those of you who are not, SOS is a leading stock administration staffing, consulting, and outsourcing firm within the equity compensation marketplace. SOS provides interim and permanent placement, expert project resources, and total outsourcing solutions. To learn more, you can visit us online at www.sos-team.com or call us at 888-SOS 0199. Next, I'd like to introduce you to our speakers for today's session. We are pleased to have Elizabeth Dodge and Kevin Hassan on the panel today. Elizabeth is a Vice President for Stock and Option Solutions. She runs the professional services team at SOS, which includes the tech, data, and strategic consultants. She joined SOS in 2008 and has been in equity compensation since 1998. Elizabeth became a certified equity professional in 1999 and co-authors the chapter on accounting in the stock option book by Alyssa Baker. She also serves on the Executive Advisory Committee of the NASPP and was also honored with the NASPP Individual Achievement Award for 2012. Kevin Hassan is a Managing Director at PwC, and he is based in Stamford, Connecticut. Kevin specializes in all aspects of accounting for employee benefits, with a specialization in the accounting for executive compensation, including stock-based compensation, short-term and long-term cash incentive compensation, and deferred compensation. Additionally, Kevin is a recognized subject matter expert throughout the firm on stock-based compensation issues. Next is our standard disclaimer slide. We'd like to remind you to consult your own advisors before making any changes. As I mentioned, the materials are available on our website, and here again is the link. You can also click the Event Resources tab on your screen and download them there. Thank you all for joining us today. And with that, I will turn this presentation over to Elizabeth, who will introduce the topic and cover the agenda. Thank you.
Thank you, Shauna. And just so everyone knows, this is actually our first webcast. We switched platforms to GoToMeeting just recently, so we're still getting familiar with the platform, and I may be asking for support from Gabriel, who's on the line as well, as things go if I have any issues. So our agenda today, we are going to cover the disclosure requirements. That's actually where we'll spend the bulk of our time, is just talking about the requirements and a little bit of the misunderstandings that go on under the requirements. The language that the standard uses is a little confusing, and a lot of people get confused, which leads to common disclosure mistakes, which we'll talk about next. And then we'll talk about how to calculate some common disclosures, also stemming from the confusing language, and then also auditing disclosure calculations, and we'll spend less time there. But let's move on. Oh, we are going to be covering some of these slides very quickly, but we did want to include them for your reference. We have a lot of slides. We have 30 slides to cover in an hour, and we want to leave time for questions. So some of these I'm just going to skim or talk about what's on there, and then we'll move on, and then you can refer to them for future reference if you need to. Okay, so required disclosures. Topics 718, 10-50-2, and 10-50-3. That actually formerly paragraph 240 and 241, and actually the example charts are actually in a different appendix. I need to update that, but that's where they come from now. I still think of them as paragraph 240 and 241, and I still refer to my old PDF of 123R to actually pull up quickly and take a look at stuff. But I did go back and check and make sure that the things that we're talking about today haven't changed significantly or really at all for this presentation. So the first thing to talk about are things you're not going to be getting from your software, your system. You're not going to be recalculating. They're just going to be a description of your share-based payment arrangements. And then you're going to talk about the method used for measuring the compensation cost, which is pretty standard across most companies. Now, Kevin, do you have any input or any wise words to say about descriptions or measuring compensation cost?
I just think you need to make sure you've captured all your arrangements. Mm-hmm. A lot of times I come in as doing audit support for my clients and find out that they'll have a table down below and not describe the instrument being offered at all. So just make sure that as you're changing your grant practices that you're updating the note as well. That sometimes falls through the cracks.
Absolutely. Good point. Thank you.
And the other thing in B, Elizabeth, just one quick one there is if you're using Black-Scholes, let's say, for your service-only awards and you have market condition awards, make sure you have both of them described there in the method used.
Yep. And it does actually, the standard does say to separate out disclosures for these various different types of instruments. And we'll talk about disclosures for options versus disclosures for RSUs. But some people lump stuff together that they shouldn't be lumping together. Like I personally think you should do performance-restricted stock separately from your time-based restricted stock. Kevin, do you have any thoughts on that?
I would agree, though I will tell you that some of my clients don't do it. I think it's just it comes down to space, the use of space, and I think that's a lot of reasons why people combine it. If it's more separated, chances of making mistakes are probably limited, right. But I will tell you that most of the time the answer when you say why is it combined is space.
Gotcha. And you don't want to make our disclosures, our 10Ks, too long because we want to get the information to the investors as quickly as we can and effectively as we can. All right, with that, we'll move on to the next slide. So here's an example. Here's a description. Very hard to read, I'm sure. At least on my screen it is. On my console it is. Just here are my stock options. Let's describe them. RSUs, let's describe them. Restricted stock and restricted stock units lumped together here, which is fine. And then if you have an ESPP, I would also, and I think a lot of people don't include their ESPP. But again, we're not going to spend any time on the descriptions. Moving on to more disclosure requirements. Now these are the paragraphs where the most confusion occurs. And the standard is written one way, but practice has gone a different way. So what I mean here is that first line of the table, it says the most recent year, so your income statement most recent year, you want to do number and weighted average exercise price for share options or share units. And on the next slide, I'll show you the definition of share units. So the standard is saying, although we think it's sort of wrong in quotes, that you should have outstanding at the beginning, outstanding at the end, exercisable at the end of the year, and then during the year, granted, exercised, forfeited, and expired for options and RSUs, which is why this says applies to, over here on the side, applies to options, RSUs, and stock purchase. Now, practice has dictated that it makes no sense, shockingly, to disclose your weighted average exercise price for your restricted stock units, which are usually granted without a price. So why would you do weighted average exercise price? So even though the standard says this, and actually at least one of the big softwares was written to do the same disclosures on their disclosure report for options and RSUs. But practice has evolved, and that second table line for the most recent year for number and weighted average grant date fair value, not exercise price because it's not applicable for restricted stock. And it says for shares not specified above, right? So anything that wasn't included above. And again, that would be interpreted to be just RSAs. That's what we have over, and that applies to table just as RSAs. And the text that was removed as part of the codification, you see sort of a little footnote there, says it used to say, for example, shares of non-vested stock. They took that piece out, but for restricted stock, for RSAs, for restricted stock awards, those that can't be deferred and those on which you can file an 83B election because they're property, they're actual stock, they're not a unit. They said they wanted non-vested at the beginning of the year, which means outstanding, but they want to use a confusing terminology to make it harder on everyone. Non-vested at the end of the year, and then during the year granted, vested, which means vested and released, generally speaking, or issued to the participant, and forfeited. But again, practice has evolved, so the first table line should be for options and units, was what the standard says, but really that's just for options and possibly for ESPP. And then that second table line those things that make sense to disclose for restricted stock awards and restricted stock units, like weighted average grant date fair value for granted, vested, and forfeited. Kevin, you said we were prepping for this a little bit, and you said you just got your first. Someone actually.
Yeah, I actually got this because somebody was actually going to do the second table for options.
Mm-hmm.
And I
exactly.
said,
and
well,
yeah, the language is not clear. This non-vested share nonsense is just not clear.
I think taking a step back in definitions, we use the term restricted stock differently in the standard than we do in real life.
Exactly.
And a non-vested share per the standard is actually restricted stock as we know it today.
Yep.
So part of the problem is in the definition.
I agree. And that's a beautiful segue on to the next slide that has these definitions. So again, they said for options and share units, a contract under which the holder has the right to convert each unit into a specified number of shares of the issuing entity, aka RSUs, right? But it makes no sense to do weighted average exercise price. So the auditor's checklist, all the ones I've seen when I'm helping companies with disclosures, they really do say, for options, do this bucket. For restricted stock, really sort of any flavor, do this bucket, do these disclosures. Now the next one is non-vested shares, and the glossary says shares in an entity has not yet issued because the agreed upon consideration, such as employee services, I'm sorry I repeated that was a typo, has not been received. Non-vested shares cannot be sold, blah, 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 blah. And then there's a footnote in 718.10-30-18, which you'll need to cite that at your next cocktail party and reference. Get that memorized so you can cite this because it's such great casual conversation. Non-vested shares granted to employees usually are referred to as restricted shares, or restricted stock too. But this statement reserves that term for fully vested and outstanding shares whose sale is contractually prohibited, blah, 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 blah. So they say non-vested shares, and the examples we're going to show you in a minute, when it's talking about non-vested shares, just substitute in your mind restricted stock awards, restricted stock units. And again, the way the standard was written, very confusing. And you have to read very closely to see, oh, this is options and this is shares. And options and shares are not the same thing. So thank you for that segue, Kevin. All right. So on this next slide, I have a typo. So I want you all, if you have a printout, I want you to take the second line and the second row of the table. There it says for each year for which an income statement is provided, total intrinsic value for options exercised or share units converted, but again, don't do this, just going to be options, share-based liabilities paid, and the total fair value of, typo, it says those, the standard says shares vested during the year. So that's my typo. I apologize. When I was transcribing it from the standard over here, I made that mistake, not the standard's mistake.
Yeah, so, Elizabeth, just one thing there. I know you said if you're not going to give the total intrinsic value of share units or restricted stock units, and you're putting them down, I don't want them to somebody to think that they don't get the total fair value of shares vested would be the intrinsic value anyways.
Agreed.
That's the same thing as the units converted, so you just got to make sure it's someplace. Whether it's you put it under the intrinsic value of the share units because it had a zero exercise price, or the fair value similar to shares, it still needs to be disclosed someplace.
Yep, and we will show that in the examples that, again, copied straight out of the standard. There is one thing that somebody's saying that the audio, I guess, Gabrielle, you're going to deal with all those technical questions. Can't hear audio. So sorry for interrupting. We're getting a few questions about not being able to hear, which is not what we want. So the first disclosure item here, again, it's just for the current year, weighted average grant date fair value for equity options or other equity instruments granted during the year. Oh, no, I'm sorry, for each year. Whoops, what just happened? My slides just advanced. What's going on? Here we go. There we go. For each year in which the income statements provided weighted average, so this is the 3-year, weighted average grant date fair value for 3 years, for this year, last year, and the year before. And then for each year in which an income statement, the second row, again, it's something you do for all 3 years. Wow, my slide is advancing when I'm not telling it to. I must be clicking by accident. Okay, and then the last one here, the last row in this table, for fully vested share options or share units and share options expected to vest, the evil words expected to vest, as of the date of the last income statement, both of the following. So they want number weighted average exercise price, aggregate intrinsic value, weighted average remaining contractual term of options outstanding, and then number, weighted average exercise price, aggregate intrinsic value, and weighted average remaining contractual term of options currently exercisable. Now the expected to vest piece is the part that gets left out of the examples in the standard. Here is the example from the standard. And this actually is the old font. It actually came out of the PDF because it's easier to take the screenshot out of a PDF than it is off the website. But you can see the example. This is for options. It says options very clearly, and we're clear that for options we're going to do, this is just 1 year. We're just doing this year. The stuff down below, the text, we have the 3 years. The weighted average grant date fair value of options granted during the years X, Y, and Z was A, B, and C. And then again, down at the bottom, total intrinsic value of options exercised during the years X, Y, and Z, or A, B, and C. So, but you can see very clearly we've got the outstanding, we've got the granted, we've got the forfeited or expired. They just say forfeited in the standard, but either way, I like the inclusion of the language here. Outstanding as of the end of the year, exercisable at the end of the year. Where is the fabulous vested and expected to vest? It's in the language, but it's not in the example, unfortunately. But that's a little graphic that this shows you. So these are the 3 years, the ones down at the bottom in the text. I have seen some companies break this out and put this in a table, the 3 years instead of, but generally it's not in the same table as the other disclosures above because you're just doing that for 1 year and you're capturing your activity and your weighted average remaining contractual term. Kevin, any comments on this?
Yeah, I'm going to kind of tell people that the expected, some people may believe the expected to vest is the amount that's exercisable, but that's not really factually correct, right? You could have some in the outstanding that isn't there.
Yep.
The other thing I was going to kind of just interject, even though it's not on the topic, but you may need to, the disclosures are going to probably be updated when the new ASU comes out, because people are going to have the ability to elect to go to actual forfeitures from a projected forfeiture. So expected to vest, that concept may need to be modified for certain people or go away. So just stay tuned on that because it's probably going to have some adjustments.
Absolutely. Makes perfect sense. And expected to vest is just that. And we'll talk more about how to calculate or how to audit it later. But so you get vested, and if we had the example, I'm actually going to take you to the next slide, which has just an example from a company where they did, it looks exactly the same, well not exactly, but very close. But look at the very last line. They have exercisable and therefore vested and expected to vest. And all that is, and I love the fact that they footnoted it, is options expected to vest reflect an estimated forfeiture rate. And when this first came out, everyone was like, what's this expected to vest thing? Well, this is crazy. I don't know what this is. And all it is take your unvested options and apply that same forfeiture rate that you're applying to your expense, except to the numbers of shares, and then calculate your weighted average exercise price and your weighted average remaining contractual term. So this is, I can't remember which company, I think this is Google. And if I got that wrong, I apologize to Google. But I think this is a very nice disclosure, very nice table. And then you can see the total grant date fair value vested during 2012, 13, and 14, and the aggregate intrinsic value, et cetera. So.
Yeah, so what this is telling you is about 1 million shares, give or take, that still have vesting associated with it, and they believe about 900,000 of them are going to vest.
Yep. Okay. And here's an example from the standard for those RSAs, and I put in parentheses RSUs because, again, the standard doesn't say this, but really practice, it makes a lot more sense to not disclose exercise price for your RSUs. So we're lumping them in together, and this is what we see in practice. So again, you've got, now look, they did call this, we did type in at the top RSAs, but they call this in the example, and they still do it in the codified version, non-vested shares, AKA RSAs and RSUs. And for them, we're just going to do shares. We're just going to do the weighted average grant date fair value. And then we're going to do granted, vested, not exercised. We don't care about exercise because we don't have, but vested is the equivalent with an RSA or an RSU of an exercise, right? It's predetermined. You know when it's going to happen, but it is the equivalent. So that's what makes sense here. And then again, forfeited, and then non-vested. Now this again does not have expected to vest. And I have seen diversity in practice about whether you do vested and expected to vest for RSAs too. But you see the example doesn't have it, but the example for options doesn't have it either. But here are all the other disclosures we've got. We've got the unrecognized compensation costs related to non-vested share-based compensation arrangements. Notice we didn't have that for options. Not sure why, but we didn't. That cost is expected to be recognized over a weighted average period of 4.9 years, another required disclosure. Total fair value of shares vested was X, Y, and Z for 3 years. Remember, that's 3 years. And then there's a modification. They have an example of a modification that they did, and they're disclosing how many options were involved, how many employees held them, and how much expense was incurred as a result of that modification, which is a disclosure we haven't talked about yet, but I think I still have a slide talking about that.
Yeah, and I think, yeah, I was just going to say, I think those bottom two, just because of the way the footnote read, but it really has nothing to do with the RSAs and above it. That's actually a remaining, that rather they should have probably put the term modification above it, and then you would have seen it separated.
Yep.
So that's one point on that one. It's not really, because someone could look at it and go, wow, that doesn't make sense. That has nothing to do with the RSAs. Well, in the scheme of the footnote, it probably does. Just one other point on the use of RSA. It could be that legally they call their grants restricted stock awards, and maybe they just shortened it to RSAs up above. So the reason because they considered it, that's the form of the award that they granted, and then they picked up the non-vested share language from the standard so that so that a reader could say, oh, okay, I understand that they're not talking about contractually restricted.
This is the example out of the standard, and the RSA was added in an old presentation that I worked on. So this is not an example from the SEC website. But yeah, it's exactly from the standard, and then we put the numbers over there for the reference so you know which thing that's talking about. But yeah, the RSAs was added by me and team on a much long ago presentation. So I would include RSUs here. That's why it's in parentheses.
No. The point I was just trying to make is if this came out of somebody's actual disclosure, they might use the term RSAs and say up above, I granted restricted stock awards versus non-vested. Nobody uses the term non-vested in their plans.
Nobody uses that because how would they? Yeah, who would know what you're talking about unless you subscribe to FASB publications? So here's an example from the same 10K. Again, I think it's Google. And you can see summarize the activities for our unvested RSUs, and they have it titled, they don't title it non-vested shares or non-vested stock, shockingly, but they have the unvested, granted, vested, forfeited, unvested, and they did include the expected to vest, which is not included in the example, but again, it's not for options either. Oh, somebody's correcting my reference. I know that guy. All right, so RSA table fair value of shares vested, they're correcting the reference. I'll take a look at that later and let you know. There's another question down here. Let's see. ASC doesn't explicitly state interim disclosures for stock comp. What do you recommend for interim disclosures? Should companies repeat/duplicate disclosures from 10Q to 10Q, or just show the activity for the quarter only? Expense would be Q to date and year to date, quarter to date, and year to date, but do companies really have to duplicate the other disclosures? Isn't the goal to reduce redundant disclosures? So I think Kevin would weigh in on this better than I, but in my experience, usually I don't see these disclosures in 10Qs at all. They wait for the 10K and they do this in the 10K, unless there's been a material change that they feel needs to be disclosed sooner than the 10K.
I think when I normally see them done interim is if there was, some people grant awards every 18 months, and the month that they granted the new awards, if there was a big 1 year or a big annual grant. And some people just keep the disclosures rolling forward quarterly, but I will tell you that the practice that I see is generally when there's a big grant, like if the company does grants once a year or every 18 months, I see them put in that quarter.
Okay, great. Oh, and the person who was correcting my references put in another comment, which is ignore my last comment. Sorry, C2 is...
Oh, looks like we lost Elizabeth on the line. She's probably trying to dial back in. Kevin, are you there?
I am.
Okay.
Okay, so this next slide is one where there are certain awards that, you don't have to, in particular, you're not required to, the total fair value of options vested is not something that is a required disclosure. I'm going to say that people, intrinsic value of exercised awards is a required disclosure, but the fair value of options vested is not necessarily a required disclosure. And so this is one of Elizabeth's big things to say, is it wrong to put it in there? It's not wrong, but it's not required. So if you're looking to save space in your notes or whatever the case may be, we don't need to do that disclosure. And so what she has here is just, I guess, the reference from where this document came from. And that's that footnote. Let's see. Okay.
Am I back? Can you guys hear me again?
You're back now.
I
So
apologize.
on 16, I took care of 15. This is the one where you said.
Yep, great. All right, so we're on 16. The vesting and the forfeit. I didn't know you couldn't hear me. I apologize. So I was still talking about 15, and I kept flipping back to 15. So I apologize. This is our first go-to meeting, as you all know, go-to webcast, and we're still learning. So not required to disclose. So this, someone has taken the unvested stock options, the non-vested stock, they read as options. So they took the unvested at the beginning of the year, and they did the granted and the vested and the forfeited. These are RSA disclosures, and they just misinterpreted the standard, and they've calculated the weighted average grant date fair value, just not required for stock options. So again, one of the common mistakes is doing disclosures because of that confusing wording that are not required. On to slide 17, another mistake or maybe a misunderstanding, or maybe they thought it added value. But the vesting and forfeited stock options, grant date fair value, same mistake being made. Non-vested is confusing terminology, so people misunderstood it. Okay. So now there's also the information. Oh, this is just a wrap-up of the minimum disclosure requirements. Description of the method, the significant assumptions used, which we're going to show some examples in a minute. And then we do want to provide this separately for different types of awards. Again, I would argue options certainly separate. I have seen some companies lump ESPP in with options because they are, in effect, an option. I've seen other companies do ESPP separately, and I've seen other companies ignore ESPP altogether. But we definitely want to keep option disclosures separate from RSUs and RSAs. And again, I usually see people that have both RSAs and RSUs separate them. And again, I usually see PSUs separate too. But to Kevin's earlier point, that may not be possible because of space requirements or space issues. Anything on that one, Kevin?
No, I was just going to say, in terms of the assumptions, obviously you want to make sure if you're using different assumptions for a market conditioned award that you're presenting it separately from whatever you're using for your service-only Black-Scholes.
Yeah, completely agree. And that would really skew when you've got performance awards. Usually those are very different expected terms and therefore very different volatility, very different risk-free interest rate, et cetera. Now this example out of the standard has a very wide range of the risk-free rate, for example, pretty big range for expected term. I've actually seen companies with big ranges, but most of them aren't this big, or they're big because you have non-employee options in there, and the non-employee grants usually have longer expected terms because you're using the remaining contractual term to do their fair value calculations. So, but this is again the example of the standard that we just talked about. And then here's some examples. I'd give you two different examples from the SEC website. Again, those ranges are not quite as big as what you're saying. The expected term of 4.2, 4.2, 4.3. And this, I really like that top example because we have a stock option grants. And then in the same area, because we're doing a Black-Scholes for ESPP. You can reuse that space, not use up more space, but they are including ESPP, but they're showing how different it is. Because the term for an ESPP is usually quite short compared to the expected term for an option. So I think that's a great example. And then the bottom one's just a more common, more regular one. And again, I have seen where people do the ranges, and that's what the standard has. I'm going to go back a slide. You can see the standard has the 25 to 40%. And then I've also just seen like the bottom example is just a weighted average, right? 3.52 and 34% and 1.85. I'm betting that these people did do more than one grant this year, but they calculated just one weighted average term rather than showing a range. Any comments on that, Kevin?
No, I've seen it done both ways.
Yep, and it doesn't say you have to do it one way or the other. And I don't think one's necessarily better. I think the weighted average is probably easier, but that's just me. All right, with that, and we're actually on schedule for a change. You guys are going to have to start asking questions to put us behind. Oh, there we go. Could you please share an example company name reference of a separate ESPP disclosure? I will find you one and follow up. I don't have it off the top of my head, especially that ESPP disclosure you just saw. I will find you this one again and send you that example and find you another one. So I will follow up with you after the webcast for that. Absolutely. So disclosure summarized, total compensation. We talked about this not yet recognized in our examples, and we talked about the standard. And the weighted average period. We do believe when we did the interpretation of this that it did apply to all the different grant types. And again, I've seen it just for restricted stock. I've seen it done for options and restricted stock. I'm not sure that the standard is totally clear whether it applies to just restricted stock or whether it should be done for each different equity type. Kevin, any thoughts from you on that?
Yeah,
Kevin on everything.
Yeah, no, I'm just going to agree with you. I mean, I think it's been interpreted where you have awards to mean any award granted that's not yet recognized, because it didn't say options and it didn't say units. It said it used the term awards. So I would think it applies to everything.
Okay, and I think that's safe, right? If you do it for everything, you're certainly not missing anything. That may be going against what I said before, which is don't do more work than you have to do, or I prefer not to do more work than I have to do. This is our mantra, as I say. We're not lazy. We're efficient. We don't do more work than we have to do. All right. And the next one is total compensation cost, recognized in income as well as the total recognized tax benefit related thereto. So we get into fabulous tax accounting. That's very exciting. Get your tax department involved. Total incremental compensation cost capitalized, which not everyone has to do, but a lot of the R&D groups do. So again, get finance. Well, you're all finance anyway, but the capitalized piece. And then we talked about this earlier, description of significant modifications. We have a couple of examples coming up, and that would be for any grant type. So one of the examples is actually an ESPP modification. This is one, I can't remember what we did. Let's see, compensation card, 2 share-based comp described below. This is just an example of this is how much is going to be recognized and what period it's going to be recognized over. Okay, did I go forward much too many? Nope. There we go. Going forward to slide 23. Again, another example of this much is going to be recognized over this period. Again, I'm flipping quickly through these because I don't think they add a huge amount of value. I'm not used to the way the slides forward. I thought I had a modification in here. I'm sorry. Performance-based. Okay, well, I think I have a modification next, but maybe I took it out. So even if you did have an ESPP modification, which does happen to some of you, with resets or rollovers or even increases, I did have a client long time ago, I want to say 2010, who had a reset hit for the first time. And we had to calculate how much expense, and literally their stock price had gone from, when people enrolled, it was less than $1. And when they were purchasing, when they were doing a reset, so a lot of people did increases. It wasn't a reset, I'm sorry. It was people were doing increases. Everyone went from, and they were at like $70. The stock price is at $70. So you were buying stock for 85 cents that you could turn around and sell for $85 or $70. I can't remember. So shockingly, a lot of people wanted to increase their contributions. And so when we ended up calculating how much the incremental expense for all those different increases was, we did end up disclosing it in their 10K because for them it took their expense from a fairly puny amount for ESPP to something really significant. So significant, clearly you need to discuss that with internal folks and decide what is significant, what is material. You wouldn't do it for tiny little modification that resulted in $10 of incremental expense. But if we're talking several $100,000 or several million, depending on your balance sheet, it might be significant in terms of your financials.
Yeah, just one thing on that. Yeah, I was just going to say, I think that you should probably keep all your modifications, even if they're insignificant, puny, whichever word you want to use. I would keep them all and just show them to your auditor and say, look, we've waived disclosure on these individual items because they do not meet what we believe is the level to disclose. But at least you have them captured there. You could show them to the auditor so that the auditor could say, yep, we agree, and we're done.
And I think we had some questions come in. Let's go back. For performance awards and shares expected to vest disclosure, would a company estimate the number of shares expected to vest based on their current measurement of expected payout of their performance metrics? I believe yes, but Kevin, please feel free to correct me.
I'm not sure I would agree with that. I think
Okay.
what you would do is you would hold the same standard that you would. I think because you're not recognizing expense, or you think the payout is something less than 100%, or more than 100%, that what you're going to do is how you account for that in the table. I think what they're getting at with expected to vest is the people you expect to stay. That's the way I've seen it done. Though I will tell you that it's a lot easier to go the way you just said it, and I do know people do it that way.
Okay. And then the question, do you have to disclose proceeds received from option exercises? And yes, you do. Look right here on slide 24. Item 50-2-I is the amount of cash received from exercise of options and shares granted under share-based payments arrangements and the tax benefit realized from exercises. So yes, the amount of cash you receive from option exercise is a required disclosure item. But if I misinterpreted that, feel free to correct me. Okay. And there was just a clarification. They're looking for a share roll forward that's separate for the ESPP. So I don't know that I have one of those off the top of my head, but I will try and find one for you and follow up after the webcast. So, okay, and the amount of cash used to settle equity instruments. If you have cash settled instruments, most of us don't, although I recommend them in China. But so most of us don't have to worry about that. And the description of the entity's policy for issuing shares upon exercise. There we go. Now, into some unnecessary disclosures, some more unnecessary disclosures in addition to those that we covered before. This table, this went away, or it became no longer required, this fabulous range of exercise prices, options outstanding, options exercisable, stopped being required in 2006 with the adoption of 123R, now known as ASC 718. So I still see this. You can see that somebody was doing it in 2010. This is a little bit older slide, still 2010. Haven't seen it as much lately, but I still get this question. Oh, my software took out the table. That's because it's not required. It's not that hard to do in a spreadsheet. You can still do it in a spreadsheet. It's a little bit harder if your report doesn't spit it out. But it is not required. And once people understand that it's not required, usually the CFO or whoever's the SEC reporting manager says, oh, well, if it's not required, let's get rid of it. Not always, but often, I will say, once they understand it's not required.
And you could see by the information being requested in here, or that was being presented here, it had an APB 25 slant to it with the weighted average exercise price and the range of exercise prices. Some people like to put this in there because it'll give somebody, a reader, the ability to see what's in the money or what's out of the money of what's outstanding at any particular point in time. But again, it was mostly, it had its roots in APB 25 because, again, what you were trying to figure out is when is something going to be exercised and how long does it take for it to get it back in the money for someone to exercise.
Yep. Okay. And then here's where we get into modifications, and here are the examples for the modifications. So this is actually the ESPP that I talked to before, and this is actually from the client's disclosures. During fiscal 2010, modification increased both the maximum employee contributions. Actually, I think this is a different one where they modified it in a different way, but it impacted their expense. We had to calculate the incremental expense. And these are some examples for modifications by ESPPs. And actually, I almost see, other than exec terminations, which are the most common modifications we see, modifications for ESPPs, at least in Silicon Valley, are pretty common because we have these fabulous Cadillac plans where you have a 2-year offering and 6-month purchases, and you let people increase their contributions, and boom, modification. Or you have a fabulous clause that says, if the price drops during the purchase period, everybody's automatically re-enrolled at the lower price. Boom, modification. Great plans for your participants, really painful to do the accounting for in a spreadsheet. And most systems don't support those, so we end up doing them in spreadsheets. So anyway, these are just examples. We see modifications for ESPP more than we see it for anything other than exec terminations, and they get the options or the restricted stock awards get modified to extend the exercise term, or they get modified to accelerate, etc. In those cases, again, to Kevin's point, you decide whether to keep a list of all of them and decide whether they're significant or not. Any other comments on that, Kevin? I have one more example slide.
Yeah, I just want to make sure, because the ones we have a couple are all ESPP modifications. You can modify options.
Oh, yeah.
Repricings could be one. Yep. I mean, I know that most plans don't permit them, but if you go ahead and do a repricing of options, that would be a modification that would require disclosures. It's not just, I just don't want anybody leaving here thinking, well, modifications are all ESPPs. It can be any grant that you made. It could be performance awards where you might change the metrics because they were way too hard to get, and now they're going to make them, so it could be any number of items. It doesn't necessarily just have to be employee stock purchase plan ones. Agreed.
And I'm sorry that those are all my examples. Bad call on my part. We have a question for performance awards. This is the same performance awards gentleman from earlier. Guess where his focus is. Does the company have to disclose the share amounts earned above or below target separately, or do they just include them in the granted or canceled line items of the disclosure respectively? I've seen it done both ways. I've seen them as separate lines, and I've seen them lumped in with granted and canceled. What's your experience, Kevin?
I agree with you on that. The standard is silent on what people do with those. Some people will put them in at whatever the maximum amount is and then adjust downward through cancellations. I've seen people put in targets and then when they settle at the end, new granted. I've seen it both ways.
Yep, and the standard, again, doesn't say, so you get to decide what's better for you, which if you're a software vendor sucks because some people want it one way and some people want it the other way, and that's the worst of all possible worlds as a software vendor, but the standard is silent. And then someone's asking, not required since, and I think we're talking about the option exercise price table, not required since FAS 123 adoption date or not required since 2010. And I'm sorry I wasn't clear. I apologize.
It was the adoption date.
Yes, I meant to be clear on that. So 1/1/2006 for most companies, not required since then. When I was pulling examples from the SEC website, that particular example was one that was disclosed in a 2010 10K. Which is why it says 2010. But it says not been required since FAS 123R was released and became effective. So I apologize that I was confusing on that. Okay, and then I think someone's commenting about volume, but Gabrielle's going to talk about that. And then here's a question specific to Kevin. He doesn't want to hear from me, Kevin. So what are your thoughts on options shares / restricted shares withheld for taxes? Do these count as treasury stock purchases that would be included on the cash flow statement and under SEC Reg SK Item 703? And the reason he doesn't care what I thought is I've already told this particular person my opinion on this. So go ahead, Kevin.
Well, now I'm in really trouble here. Because
now you're in trouble because you're going to disagree with me. No, it's fine.
I don't know. I think the actual answer is going to depend upon how you're accounting for those. Some people... There's three ways that I've seen them done, right? One way is you actually have them as treasury stock and that's the way you account for it. So that's one way. The second way I've seen it done is that you just don't consider them as ever being issued. That what you did was you never issued the shares, you just issued the net number of shares. And the third way you could do it is you issued them, immediately bought them back, and canceled them. It all depends on how your plan is worded as to what happens with those shares. If you can reissue them, you're obviously not going to do the latter. You're not going to consider them as being canceled, right? So now it gets you into one or two, and I would argue you're probably closer to two that you never really issued them rather than had them as reporting them as treasury stock. So I think the answer is going to depend upon, one, what your plan says, and two, what you actually are doing. I mean, I've seen people do them as treasury shares. I've seen people as not as issued, and I've seen people as canceled them. Yep.
And I think that white paper that we collaborated on for the NASPP, Kevin, that does have two different examples. One where the shares would be reissued or available for reissuance, I should say, and one where they were considered not issued. And we had different journal entries for that. So, and for anyone who is an NASPP member, there is a white paper available on the NASPP website that both Kevin and I and some other fabulous people worked on covering those journal entries. I know. We're talking about disclosures, though, not journal entries. Okay. So disclosure mistakes. And again, when we say mistakes, there are some of these that I think are mistakes, and there are some that it's somebody's choice. They did it differently than Elizabeth thinks it should be done, which doesn't necessarily make it a mistake. That's why I put that in quotes. But not including ESPP, that means maybe it's just a drop in the bucket, and people said it's not material. We're not going to jump through all these hoops to include ESPP. And to someone's point earlier, the question was, can you show me a roll forward of an ESPP that's separate? Not off the top of my head, but I will look for one. And then including unnecessary disclosures. We've been talking about this the whole time. Again, why make more work for yourself? Simplify. Get rid of that fabulous price table if you're still doing it. That weighted average fair value for options vested and options forfeited. Not required, just a misunderstanding of what the standard says. But again, your CFO or your SEC reporting manager may feel that that's important information. But the FASB didn't. The FASB said, nope, this is what we want for restricted stock. This is what we want for options. They're different beasts. We're going to do different disclosures for them. I don't like, Kevin doesn't think this is a mistake. I don't like when you lump RSUs and PSUs in together. They're very different beasts again. I think they should be treated separately. I know at least a couple of softwares lump them together, and you have to specifically filter them out and say, I want to run one report for my RSUs and one for my PSUs.
Well, can I just stop there for a second? I'm not disagreeing with you on whether they should be separated or not. I think they should be. But where I've seen them is two tables right next to each other, one being RSUs, one being PSUs.
Oh, gotcha. Great. Yeah, and that's space. That would save that space just like the option, the ESPP we looked at before. That does give you the same amount of space, use the same amount of space, but give you more information. Okay, we have one more. We have one more question from the performance guy. Hopefully my last question on performance awards. Let's say we have see, I knew you guys were going to put us behind schedule. We were on time, which is why the question. No, it's all good. Hopefully my last question, let's say we have a performance award with a performance period and then a holding period. Or maybe a continued vesting period. I'm not sure. Maybe it's just a holding period. After the performance period, the performance awards are considered restricted stock. Yes, so does it with time-based vesting. At this point, do we disclose these awards along with the regular restricted stock or keep them with performance awards? I'm going to say it depends, but Kevin can correct me. I would again say the standard doesn't specify, so you could do it either way. I don't know.
Well, what you need to be careful on is that if you are moving it from performance shares to restricted stock at that point in time, or non-vested stock, whatever word you want to use here, that you're not double counting it.
Right.
So that's one where it's conceivably possible that if you chose to leave it in performance, I don't think anybody would question it. If you chose to move it over, I don't know that anybody would question it, but you got to make sure you're taking it out of the performance and you're not double reporting the same share of stock.
Well, and I think moving it would also be problematic for those things where you're doing 3 years of reporting, right? That moving it, like last year it was in PSUs and this year's it's in RSUs, so now do I go back and move it?
That's one of the reasons why I've never seen it move, to be honest with you, but I know that some people may argue that it's not a performance award anymore.
Right. Yeah, it makes sense. But I think it does get tricky if you start including it with your regular time stuff. Yeah. Oh, and the last question is, what is the name of the white paper? I don't know off the top of my head. I will get you that information. This is on the website.
My understanding, Elizabeth, was there was a whole bunch. There was like 5 or 6 different instruments. Like there were stock options, there was restricted shares, there was performance.
We have all kinds of examples in that white paper.
Yeah, so there was like 5 or 6 or 7 or 8 white papers that are out there on what.
And we had an example. No, it was all in one big white paper, but I'll find you the name of the white paper. This person who's asking, I know your email address, so I will find you. But if you go to the accounting or the valuation portal on the NASPP website, it is on there, and you can just search for journal entry, and you'll find the white paper. But I will get you that exact link as well. I'm going to have some follow-up items after this. All right. So I didn't talk down here, not including non-employees. Non-employees, it may be just one non-employee and it's immaterial and you don't want to include them on a separate report. Having a whole other section for non-employee disclosures, maybe put them next to each other as we're doing for options in ESPP. But if it's material, if you have 25 or 75 different non-employees you're granting to, they're going to skew your volatility and interest rate a bit and look a little bit weird. But B, I think they should be included. either separately or lumped in with your employee grants. And then, even though they're accounted for quite differently, and then defining non-vested as unvested options. I think I've beaten that horse to death.
Can I just say one thing?
Yes, please.
On the unnecessary disclosures? If you've been carrying these disclosures for a number of years, you need to think about, if you pull them out now,
right,
is someone relying upon those disclosures? While they're not required, before you pull them out, you need to think about, are you going to be criticized for not having that level of disclosure? So I'm just pointing it out that I agree it's not required, for example, a price table, but if it's been there for a long period of time, to pull it out, just pull it out totally, may cause someone to question your disclosures.
Yep. And
not necessarily the SEC, but someone else who's reading it.
Right. Yeah, who has been reading it and is relying on certain information to make an assessment, and then suddenly it's not there anymore. It might be confusing. So last question we have so far is the options table. Are the exercise price ranges required or only the weighted average exercise price? It's only the weighted average exercise price. So as we've been talking about, you may have missed this part, that table, that fabulous table, we're going to go back to it. This fabulous table, which was required, is no longer required since the adoption of 123R now.
I think when you go back to the beginning, we talked a little bit about that there's some weighted average prices that you need to disclose, which is the fair value, right?
Yep, correct.
I think people have mistaken, this is one of those mistakes where people have done the exercise price or put a range of exercise prices or whatever. Again, and that gets back to this unnecessary disclosure. When you pull it out, and if someone's relying upon it, you will get questions about it.
But it does, the standard is specific when it talks about what's required for options, that it does say weighted average exercise price. That's what it wants. It doesn't want from here to here. It wants to know weighted
But I'm going to tell you, people do it.
I know. I don't doubt you ever on anything, Kevin. I never doubt you, anything you say. All right. So we don't have a lot of time to talk about calculating common disclosures, and it was in the webcast description, so I apologize if anybody showed up just for that and you're getting disappointed, but you can always contact us offline for help with this. The weighted average grant date fair values, this is the most common request that I get, because at least one software, because the way the standard was written, it did say, if you missed the beginning of the webcast, you missed the really exciting part. It said, for options and units, do these disclosures. For non-vested shares, aka restricted stock awards, not RSUs, do these disclosures. So at least one very popular software took that literally, as most of us would, and said, okay, for options and RSUs, here are the disclosures. For RSAs, here's a different set of disclosures. But again, oh, I'm getting a little reminder that we're ending soon. Yes, I know we're ending soon. So now I'm back to my same slide. So that particular software doesn't give you the weighted average grant date fair value for your beginning outstanding, for your granted, for your vested, for your forfeited, or your ending outstanding. It's really a very easy thing to calculate. It's just find a report that gives you outstanding as of the beginning of the period, pull in fair value per share, and I do this at the grant level. You can also do it at the tranche level if you have a report that gives you beginning outstanding. For vested, I typically do use a tranche level report so I can see, did that vest during the period? Oh, it did. And I have an example on the next slide. But for beginning outstanding, multiply outstanding as of the beginning of the period times that fair value per share for that grant, sum that column up, and then divide by the outstanding at the beginning of the period. So you're always going to, that's your weighted average. Now, I have seen some people not use shares for these, but instead use values, also for forfeiture rates, using values. That doesn't make a lot of sense to me. If we're doing outstanding, we're doing granted, we're doing vested, we're talking about share amounts. So we should be using the outstanding to do the multiplication times the fair value, and then also when we create our weighted average by dividing by the sum of all the shares outstanding for everybody, that's what we should be using as a factor. Granted, again, really easy. You can do that from any granted report. For me, and I'm going to show you this example in the next one, vested, unless you have a report that shows you vested, which some people during this period, some systems do and many systems don't, I actually create a little spreadsheet that I check to see. I check is the vest date greater than or equal to the beginning of the period and less than or equal to the end of the period, and I use the AND function to do that. And then if that's true, then I say vested equals this many shares. I'll show you the example in Excel in just a minute. But that is probably the most common thing. It takes 5 minutes to do in Excel, but the most common question we get. So calculating that one. Not rocket science, but if you've never done it, you have to work out the spreadsheet steps. It's not that hard. Forfeited is not the same as canceled. Please don't think that forfeited is the same as canceled. It is canceled before vesting. So please remember when we're talking about forfeited. Now, some people would argue, and the disclosures say canceled or expired. For options, they could be expired as well, yes. But for restricted stock, we're talking about forfeited. So these are the common disclosures. And then ending outstanding is just the same as the first bullet. Any comments or questions, Kevin, on that one? We're almost done.
Nope, I'm good.
Okay. Moving, just to show this quick example, you can see up at the top, this is a quick example. This report from this software actually gives you the tranche level detail for each option. You can see grant number 644. It has multiple rows and has multiple vest dates. And some of them are the same and others are different. But check to see this little formula you can see up in the formula bar. And is the vest date greater than or equal to and less than or equal to? And I'm looking at those two dates at the top in S11 and S12, or S10 and S11, excuse me. So, and then if vested is true, then I'd bring in the number of shares there, and then I'd do the multiplication out to come up with the weighted fair value. And then I take that column W and divide it or sum it by the vested shares. So sum the weighted fair value outstanding, and then sum the vested column. That gives me my shares. And voila, weighted average fair value of shares vesting during whatever period you need. So sorry, that was too quick. Checking for more questions. Okay, someone's telling me that that software that I was referring to just added the RSU, weighted average fair value, to the valuation of options and awards granted. So I will check that out. Thank you. All right, so auditing, and again, this is the most common. I know we're running out of time. This is the most common question I get for auditing. How do I recalculate that expected to vest number? And there are lots of systems with lots of different methods for applying a forfeiture rate. This is the simplest way that gets me the closest on most of the systems. So some of the systems use very complicated formulas that you can't recalculate en masse. You've got to take this option and say, here's my unvested, I'm going to do this math, blah, 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 and I've got to do it just for this option, one grant at a time. Really cool, hyperbolic, fancy forfeiture rate calculations. This, though, this formula that you see right here, unvested, so first you take vested, then you add unvested times 1 minus your forfeiture rate to the power of the remaining service period. It's not going to be precise on a lot of systems. Some it will get you really close. I've gotten within like 13 shares of what the system did. Some it will get you really close. Other systems have a much more complicated formula, and it's not going to get you that close. But it usually gets you close enough that the auditors go, okay, makes sense. And the remaining service period, don't do this at the tranche level. Most of you are using straight line amortization or recognition. So don't be doing that at the tranche level. You want to say that final vest date minus the end of the period, whatever date you're calculating, divided by 365.25, or you can use that fabulous year frac function. I apologize that we went so quickly through that last bit. There's our information. We don't have any additional questions that came in. So if you need to get a hold of us, we will follow up on the questions that came in during the session. And thank you so much, Kevin, for joining the webcast today. Really enjoyed it. And turning it back over to Shauna.
Great. Thank you so much. Thank you, everyone, for attending today's educational webcast. We do apologize for any technical issues that you may have had today and for bearing with us. Again, this was our first time using GoToWebcast, but all in all, I think it was successful. Thank you, Kevin and Elizabeth. Go ahead and please look for an email in the next few days with links to the recording and materials. And have a good day. Thank you so much. Bye-bye.
Thank you.
Thank you. Bye.